All right. Hi. Happy holidays. Selamat Hari Raya to all. And it has been a good 2 days of holidays. Monday and Tuesday is a holiday. And I hope you guys have enjoyed your break so far. And of course, I think tomorrow is also a holiday. So isn't it great? Yeah. So of course, this gives us traders more sleep because we don't need to actually wake up early to actually go to work. Yeah, and this is our show, Traders Talk. And for those who have joined us today, welcome. And we are going to have another exciting show today, talking about the markets and also giving you some trainings and tips about trading the stock market using options. Yeah, and of course, it will be great if you guys like and share the show so that we can get more people in and into this show and also take great learning points out of the show from us. Yep. And okay, yesterday and actually last week itself, and it is actually a very, I would say, not so nice week for traders. Of course, if you are long the market, then it will be quite a bloody red days since last week itself. And of course, yesterday itself, if you have actually seen the market, of although at the end of the day it was red, but in between it was also not too nice of trading day. Yeah, we'll go on recapping the market, what has actually happened last week, and also yesterday itself, so that you guys would be how to say, would be a much I would not say much more ready, because nowadays the market, you do not really know when it want to actually go up, and when it actually want to come down. Of course, although overall, where the market is, I mean, tend to land. I mean, if you have followed us on Traders Talk, right, for the past several weeks, we would have actually anticipated that, of course, the market is actually expected to come down all the way down to the previous lows just before the FOMC meeting, which is actually expected today and tomorrow, if not mistaken. Yeah, to actually also announce the expected rate hike. Yeah, and let's put up the chart. Let's put up the chart so that we can actually talk a bit on the markets last week, and also the price action in the past week and also yesterday. Where's the chart? Okay, this is the chart. Okay, so if you guys see the chart, right? Okay, actually, what happened was this was actually the last week's closing was actually last week, 29th of April was actually here, right? Yeah, this was actually the close last week. No, yes, 29. Yeah, this was actually the close last week. Yeah, it ended, it bottom almost to the previous low here, previous low here. And of course, yesterday it actually went down even further, creating a new low for the year of about 41, new low for the year of about the new low is actually at 4062. Yeah, 4062, the new low. But of course, towards the end of the market, it actually ended up, it actually rebounds up to close above again the previous low here, and also Friday's low. Yeah, and of course, if you actually see, this looks like, no, it's actually like a bullish candlestick, right? It's actually a bullish candlestick. But of course, I would say, because of the market volatility, although the candle looks, it is a bullish candle, right? I mean, it does not necessarily mean that the market will actually immediately go up. I mean, we also saw the same similar candle on last week, right? On actually on Tuesday. 25th was actually Tuesday, right? Yeah. So we also saw a very bullish candle on Tuesday, but the next day, basically, the market actually came crashing. Of course, those who actually jump in immediately would actually see their trades actually go all bad. Is it all bad? Because subsequent to that, the market went down lower. It recovered one day before coming to a crash on Friday. Yeah. So what we did mention about 2 weeks ago, somewhere around here, right, is that the expected Fed meeting was actually 3rd or 4th of May, and the rate hike is actually expected to be implemented on the 5th of May. Yeah. Until then, we actually expect the market to actually continue to actually come down to test back the lows, which in fact, of course, if you see now, it actually did. It actually did even worse. It did not. It did not only test the lows. It went lower than the previous lows. You see, yeah. So of course, for traders who has been actually hiding behind what is that, below the previous low, right? All of them would have actually been taken out by the market makers. Yeah, so all would have actually been stopped out in their trades if they are actually hiding just below the previous lows. You see, so if you're hiding below this low here, you would have been taken out last Friday. And of course, if you have been hiding below the February low here, yeah, 24th February low here, you would have been taken out yesterday before it actually bounced back up. So it's actually very frustrating for traders, especially stock traders who have put up positions and thought that it would not actually go to hit the previous low, right? Of course, if you're actually trading options, then of course you can actually put your positions even lower than the previous low, by structuring trades like bull put spreads, bull put spreads, yeah, bull put spreads. And if you are adventurous enough, perhaps some naked puts, yeah, and you can actually get more safety margins below, much more lower below previous low. Yeah. So if the market actually after the FOMC meeting, we are not sure what the Fed will actually announce, what they will actually say, but generally, of course, the things which they will announce is the expected rate hike of 50 basis point. And of course, it can also be 75 basis point. And the consensus, of course, now is more towards 50 basis point, but we would not preclude that the Fed would actually do a 75 basis point. Personally, I would think 50 basis point would also be likely, yeah, because the first round they actually implemented 25 basis point hike, and this round, if they implement 50 basis point, hopefully they can actually push down the inflation rate, right, which is actually running at above 8%. Yeah, so this is actually something which we will see in the next 2 days. And of course, if I would say if it is actually 50 basis points hike and not 75 basis point, which is what the market expect, then perhaps hopefully we can actually see that the market actually go back up, because this is actually on expectation. Yeah. And today, of course, we will also I mean, in case that the market rallies back up, right, just like what has actually happened in the previous rate hike here, where after they actually announced the 25 basis point, the market has actually rallied up all the way from bottom here all the way up to here. Then of course we would want you to be actually prepared to actually capture this upswing. Yeah, I would not say that if there is any upswing, again, because of the market volatility, it may not be long. It may not be long or extended. Then of course we would actually also want to save a bit of cost or reduce our trade pricing by having long calls in the market. Yeah, that's why today we will also cover how to actually reduce your cost of long calls. Yeah. And for Nasdaq, it's actually similar kind of position. Of course, the market has actually came down again, get going below the previous lows also, below the previous lows also. Yeah. And this has been happening since last week, right? Taking out the first low this day, then another day going on a lower low, and then on Friday another one, and then yesterday itself another round hitting all the way to 12,716 points. Yeah, and of course closing the day with again a bullish candle. Yeah, so don't be don't be misled. Of course the market is still going to be volatile within these next 2 days, where the price action, intraday price action, can be up and down, up and down, up and down. Yeah, very volatile depending on what statements the Fed actually puts out. If say the statement is good, then it will go up, and then suddenly a negative statement comes out, then it will go down before the market how to say stabilizes and go up again. So if you are trading intraday, of course there is actually going to be quite a lot of opportunities arising from this big swing up and down. Yeah, of course, if you are swing trading and keeping positions for more than a day, then of course the risk would actually be much higher. Yeah. And the other thing we actually also want to cover is actually on the VIX. Yeah, on the VIX. Okay. I mean, we have actually covered VIX many times, and this is actually again a recap for you guys. The VIX actually measures, this is the S&P 500 VIX, right? It actually measures the market volatility and also the what we call the fear index, right? And what has actually happened? This was actually on yesterday itself, right? Once again, VIX has actually spiked up above 35, above 35, above 35. Let me put in. Where is that? Okay. Yeah, here above 35. Here you can actually see, right? It has actually spiked up above 35, going all the way up to about 36 before closing at about 32. Yeah, because the market has actually rebounded end of the day, right? To slightly plus for slightly plus, yeah, I think about 20 over points plus for S&P. So it has actually came down, but during the day it has actually gone up all the way above 35. And if you look at the history of VIX and also the correlation with S&P 500, right? What has happened this year is that it has actually spiked above 35 four times now. One time is actually on 24th of January. And then the second time is actually on 24th of February. The third time is actually on 8th of March. And this is the fourth time on 2nd of May. Okay. And for each time, when the VIX spike, right, let's see what has actually happened to the S&P 500, SPX, right? SPX, after the VIX has actually spiked up to 35. Okay, and if you look at this chart, right? You look at this chart. Okay, we go back to the same dates, and what has actually happened here is this. Okay, so this is actually on 24th of January, right? 24th of January, VIX spiked up to 35. Of course, on the next during to the lowest point and to the next trading day, right? S&P 500 has actually gone up by 3.14%, which is 132 points up. Post after VIX has spiked to 35. Okay, and then the second round in 24th of February, yeah, VIX spiked to 35 again, and of course from the lowest point on that day up to the next trading day, VIX the S&P 500 has actually gone up by 6.47%. a single day, that means from the lowest point on the day before up to the closing of the next day, S&P has actually gone up by 6%, 266 points. And then on this third time round, which was actually on 8th of March, VIX spiked to 35, and the next day, from the lowest point up to the highest point on closing the next day, S&P has actually gone up by 2.96%, 122 points. Okay, so of course, this is what has actually happened in the history in the past 3 times, where VIX has actually spiked up to 35. And again, this time round, this is actually happening. This is actually happening yesterday, and of course, what do we expect right now? Of course, the high chance for the market to actually go back up the next day, that means today, to actually go back up, unless of course the Fed give out very negative news, which I doubt there would be more negative news than what they have right now. Of course, everything which they expect to implement, the market would already have actually factored into the prices. And of course, yesterday's low is possibly one last round where the market makers actually take off the trades, which is actually at these low points here, and hopefully it can actually come back up. Of course, if it do not come back up, then of course we will actually put a bit of insurance into our trades by making our trades cheaper, just in case the market does not rebound immediately. And if we lose in the trade, then of course possibly the trade we will actually not lose that much and exit the position until the price action is more certain. Then of course we can actually re-enter the trades with our strategies. So this is actually on the VIX, and also how the market behaves when VIX actually spikes up to 35 and post that, what has actually happened in the past. Okay, let's go back here to the slides here. So you guys get it, right? I mean, if you have any thing that you want to clarify, please post on the chat so that I can also answer them. Okay, let's put back the slide. Okay, so if you look here, this we have actually covered here. Okay, this was actually the one which I mentioned, 24th, post that VIX spike to 35 on 24th. Then after that, it went up 132 points on 24th February. VIX spike 35. Post that 266 points next day. 8 March 122 points, and 2nd of May question mark. Okay, but of course the rallies post all these dates, some have I think most of it has actually gone past few days. I think the longest being the one on the 8th of March. S&P has actually rallied up back by 7 or 8% at least post this. Okay, this was actually yesterday. If you look at the heat map yesterday itself, you can actually see that a lot of the companies are actually in green. Compared to the past week, right? Compared to the past week, you can actually see most of the companies are in red, except for Facebook, because Facebook, I mean, they have actually announced that the market accepted their earnings, which was actually favorable to their future because they are cutting down expenses, right? They're cutting down expenses, and the market actually buys buys in, and it has been quite good for Facebook post announcement. In fact, yesterday it has also gone up by quite a lot. Yeah, and let me see. Yeah. So this was yesterday, right? Yesterday, Google also went up. Facebook, Microsoft went up at the end of the day. In between, it actually went down. Post that it went up. Apple did not move much. And then what else? I think some of the banking stocks has gone up again since the past 1 or 2 days, probably in anticipation of the rate hike, which is actually favorable to the banking sector. Yeah. And then what else? All remain to be strong. The healthcare sector has actually how to say died off. Okay, because if you compare about 2 or 3 weeks ago, the healthcare has actually rallied quite a lot. I mean, if you look at companies like UNH has actually gone up to about 540 over 40 or $50, and of course right now it is actually coming down close to 200, slightly above 200, 500, yeah, close, slightly above 500. So it has actually came down a bit. J&J it has also came down a bit, and of course, I mean, whether this is actually a sign that people has, I mean, during the time when the market was actually coming down and there were actually more uncertainty, people were actually moving into some of these defensive stocks. And of course, right now, when things are going to be how to say clearer with the rate hike announced in the next 1 or 2 days, then of course it might be a rotation back for them to higher growth sectors on the tech side. And of course, if it's on the tech side, still keep on to the sectors or the companies which is actually making money. I mean, companies like Google, Microsoft would be probably safe bets. Facebook, yeah, probably safe bets. And of course, the not so safe one companies like T-Dog, right? T-Dog, which has actually crashed all the way down after its earnings to, I don't know, now $20 over, and other crappy stocks like Peloton, Lemonade, and all this, which has actually crashed down below $20. Yeah, $20. Okay. So this is the segment where we actually want to actually share with you how to actually lower the cost of your calls. Okay, because there are a lot of traders out there. When they actually trade, right? They only know how to actually trade using calls. I mean, if they are bearish, then they actually use puts. Okay, and of course, one thing good about calls is that it is very directional. Of course, when the market or the stock price is actually going along to your direction, then of course you can actually see the profits very fast. But the downside is that it is actually very expensive to actually buy a call. And of course, if you go on a longer dated call, then it will be more expensive. If you go on a shorter dated call, it will be cheaper. But chances of your call becoming worthless if the price direction is not fast enough and not going your way. That means, not if you buy a call, then you have to go up immediately after you buy the call, right? If it don't go up immediately, or it go down and it stays unchanged, then eventually your call value will actually diminish very, very fast. Okay, and of course, to avoid that, right, you can actually make your calls how to say cheaper, and or also while waiting for the price to actually really move into your direction, right? Then you can actually have a bit of so-called insurance also, just in case it don't move so fast. Yeah, so fast. Okay, the most simple way for you to actually do a cheaper call is, of course, to do a bull call spread. Okay, a bull call spread. And what is a bull call spread, right? And it is just very simple. You buy a call and then you sell a call at the higher strike. Okay, for example, you buy an Apple call at $155 and you just sell another call, same date of expiry, at say 160. And of course, why 160? Why 160? That is basically the price where you actually expect the stock price to actually land on the date of expiry. Okay, because the short call, the call which you sell, will basically cap your profits. Will basically cap your profits. And if you buy a 155 call and you sell a 160 call, what it means is that and say you're doing it to 20th of May, right? You expect on 20th of May, Apple will actually go to 160. And of course, if Apple go to 180 on 20th of May, right, your profits will only be kept up till the price of 160. That means 155, 160 is $5 width, right? Less the cost of the spread, then that is actually your max profit. I mean, if you go to $200, $300, $400, you will not enjoy that. Okay, so that is actually the downside. You will not get any benefit above your short call strikes. But of course, it lowers your cost for you to actually do the trade. And if you do not expect Apple to actually go to say 180, right, then why buy a call and pay for the full price when you can actually just reduce the cost down to by selling a call at 160, which is the price we should expect Apple to actually go there. Yeah. Okay, so that is actually a bull call, and of course on the right side here you can actually see the risk profile where you see here the the profits will actually be capped, and of course this here is actually the cost of your trade. Yeah. Okay, the second type of how you actually reduce your cost of call is to actually sell a higher call price with a different date of expiry. And this is what we call a diagonal, and we have actually covered the diagonal concept in last week's traders talk, where we actually talk about the rent and lease concept, where you actually buy a call, you buy a long dated call, it can be 3 months or 4 months or 5 months call, and then you sell a shorter dated call. That means a call with earlier expiry, a shorter dated call with a different DTE. For example, you buy a 4 months 4 months call on Apple at strike 155, for example, and then you sell a call 14 days expiry at say 160. Okay, and how you actually structure this and the risk profile would actually be like this, where you will actually it will actually be max at the short call strike. For example, if you sell a shorter dated at say 160, the longer dated one is actually at 155, then this peak here is actually will be at 160, and you need to actually structure this kind of diagonal so that there is actually no risk to the upside. That means the curve here, you do not want to actually sell a call where the curve will actually come down below the green line. I mean, if it comes down below the green line, means that when the price actually goes higher, you may make losses. Whereas when you actually structure a diagonal with the red line above here, above the green line, then of course even though the price of the stock goes above your short call, you will still make profits. Yeah. Okay, so this diagonal, if you want to actually learn this diagonal, go back to our traders talk last week, which is actually all on our Facebook page. The recordings are all there. You can actually do a review how you actually do this diagonal setup. Okay, the third way, yeah. So the third way, I hope I'm not getting too fast. Okay. Okay. The third way is actually to sell same price call. That means, say you're buying Apple call, 3 months expiry Apple call at say 155, and then oh sorry, typo here. It should not be a different DTE. Yeah, different DTE, correct. So let me. Oops. Okay, so you buy a 155 3 months call, and then you sell 155 a call, shorter DTE with a different shorter DTE. That means 2 weeks call at the same strike of 155, same strike of 155. Then of course the risk profile will be like a mountain here, That means your profits if will be there if actually the stock trade in range between this line here and this line here. If it trade in range, you will profit. And of course, once the short dated call expires, yeah, you can actually renew sell another short dated call to actually continue the trade. And of course, if the price don't move, you can sell back at the same price. That means to create another calendar. And of course, if the price move, then you will actually convert your calendar into a diagonal. Yep. Because if the price actually move up above 155, say it goes to about say 159 after 2 weeks expiry, then of course you would not actually sell another call at 155. You would probably sell a call at 165, for example, 165. Yeah, then it converts into a diagonal from a calendar. Yeah. Then the third way is to actually sell a put. Okay, that means you have a call, you buy a call, say Apple 155 call, and then you sell a put. Okay, you sell a put. This is basically a naked put. Yeah. So of course, for those who are not familiar with naked put, please go and revise what is a naked put, because the naked put, the risk is actually an undefined risk. That means basically you can actually have a max loss the same as the put which you actually sell. Yeah, sell. So when you buy a call say at 155 and you sell a put at say 155, okay, what that translate into is actually what we call a stock synthetic. Okay, what is a stock synthetic? That means basically a synthetic stock. That means basically your option will actually mirror what as if it was actually the stock 100 stock, especially if you are doing a 50 delta call and a 50 delta put, then that is actually a perfect equivalent to 100 delta, which means that it is actually 100 stock, 100 shares. Yeah, then the how to say, the risk profile will actually be just a straight line. That means if the stock price goes up, then say by $1, then of course your option value will also go up by $1, because it's actually having 100 delta if you actually structure it with a 50 delta call and a 50 delta put. Yeah, and of course if you are doing with different different price, that means if you say you sell Apple buy Apple call at 155 and you sell Apple put at say 135, yeah, that is also possible. Then of course with that kind of structure, it is not 100 mirroring 100 stock, but of course you have a slightly different risk profile, like this on this part here. Yeah, where you will have a line here being the difference of the strike prices. Maybe this, if you are doing at 135, yeah, this is 135, and this is actually 155. Yeah, and of course once the stock goes up, yeah, you actually enjoy here, then you will still be protected on the put side by a difference of, say, this example about 20. That means if the price move down, your naked put will still be out of money until it reaches 135. Yeah. So this is actually a safer form, but of course the P&L would not be as fast as this fully synthetic stock, which mirrors how the stock behave. Yeah. Okay. Then the fifth one, yeah, the fifth way is actually to sell a bull put spread. Okay. So to sell a bull put spread, basically what it means is you buy a call at Apple call at, say, 155, and then you sell a bull put spread. And if you're doing a bull put spread, say at delta 20, maybe you are actually going to sell Apple sell Apple put at 135 and buy a put at 130, for example, 135 and 130, and that credit which you actually receive from the bull put spread will reduce the cost of your call, will reduce the cost of your call. Yeah. And actually all this, right, all this 1 2 3 4 5, right, is in a way what we actually call financing your trades. I mean, it's like borrowing money to actually finance what you purchase. Yeah, because in each of these structures which we actually say, right, 1 to 5, right, you actually get a credit. And if you do a straight call, you're actually doing a debit, right? You're actually paying for it. And if you actually sell a call, whether it is a single call or whether it is actually a spread, or even a put, right? You even sell a put, right? Then of course these are actually so-called credit trades, and the credit trades actually will reduce the cost of your trade. But the thing which you guys also have to know is the risk profile, because if you are actually doing if you're just doing a straight call, then of course you will lose. Maximum is the price of what you actually paid for the call, right? Yeah, so that's a max loss. But of course, if you're starting to actually do all these other structures, right, some of it will actually also result in higher losses. For example, when you're actually selling a put, it may result in a higher loss than if you are just doing a straight call. Yeah, if you mix with this, then of course the risk can be higher. And of course, if you are selling a bull put spread, then of course the risk for the trade will be the cost of your call. On top of that, the risk would also be on the bull put spread. Yeah, bull put spread, which you can actually lose the difference between the credit received and also the width of the strike. Yeah, so all these you have to actually also understand the risk profiles, and also what will actually happen if the stock goes against you, and also what action you actually need to do in case it goes against you. Of course, if the stock goes along your direction, then it can be good. But of course, if it go up too much, then it can also be not so good. For example, if you're talking about doing a calendar, if it actually breaches the right side of the calendar here, then of course you will actually start to make losses. Then of course you need to actually repair the trades by moving the risk profiles over to the right side. Yeah. And similar to all the other structures below here, you actually need to learn how to repair trades. So these are the 5 ways how you can actually reduce the price of your calls, and also give you a bit of insurance in case the price don't move immediately along your direction. It takes some time. So these are some of the ways which we can actually use to do that. Yeah. And if you have any questions, if you on these strategies, if you how to say, if you are uncertain how to do it, or if you have actually did it before, if you have actually faced difficulties in managing, please post it on our Facebook page or email us on support. Then we would be most happy to actually reply you. If you actually want to test out these structures, you can also use the how to say, demo accounts in Thinkorswim. There's a demo account. You can also test this out using the demos and how all this how to say, how all these um, strategies actually behave with the price action. Yeah. Okay, yeah, and this Facebook user, most tech stocks, most tech crash. Now, of course, for this year, I would say tech has not been so good to us as compared to 2021. Yeah, and of course, if you talk about tech, right? The I mean, we just wrote about this in our newsletter this week, right? If you talk about tech, basically all the strong techs, right? Strong techs have actually crashed between 20 to 30% this year. Yeah, strong techs would mean companies like Google, Microsoft, Facebook. Facebook slightly higher, I think about 30, slightly about 30%, but now probably recovering. Yeah. Amazon, although it crashed, how much, 13-14% after the earnings, it is still how to say, not as much as stocks like T-Dog or DocuSign, those type of tech. Yeah. So if, of course, if you are actually investing in tech, then again, work on the strong techs which are actually generating income, making money, paying dividends. Yeah. So these are the safe bets. Of course, right now, up to date, the Nasdaq, I mean, has actually gone down close to 20%, right? For April itself, it went down about 13%. And of course, some of the stronger techs may not have gone down higher than this for the past month. And some has actually been quite resilient to the market reversal. I mean, stocks like Apple, I mean, relatively for the past few months, it has been trading at about 150 something. 150 something. And of course, Microsoft, I mean, it has actually came down from the high of about 320 over to 330, now about 280, right? 280, right? So it is still considered quite strong. And of course, when the market rally back up, okay, these are the stocks which is actually expected to go together with it. Of course, if you're saying that stocks like, say, Peloton has actually gone down to all the way to below 20, right? Below 20, then it's actually so cheap because it has actually gone down by 90%, right? Then wouldn't it be actually a good bet to actually buy that stock? Okay, of course, it has gone down by 90%, and if you actually buy that stock, right, depending on when, I mean, when it was actually down by 70%, you would say, perhaps it's actually a good stock because it has actually gone down by 70%. What's the downside? There's only 30% left, right? So you buy the stock when it has actually gone down by 80%, then actually go down by another 10% to 90% drop. So for those type of stock, you do not know when it will actually go down further. And of course, if you're betting on it, right, you would need to actually have the mindset that whatever money you put there, you are willing to lose. You're willing to lose 100% of it, 100% of it, yeah, for the potential upside. If you have that kind of mentality, of course, you can actually trade those stocks. But of course, for me, I would rather actually go to put that money, right, on say Microsoft, right, put that same amount of money that I'm willing to bet on a stock which is 90% down, and I don't know whether it will actually crash to zero, right? Rather put that stock and earn less on a stock, safe stock like Microsoft, yeah, Microsoft, or even Google, yeah, Google. Okay, so this is what I actually wanted to share, and of course, if the market rallies within the next 1-2 days, then you can actually adopt these kind of strategies. If you actually want to reduce your costs, or if you're still uncertain whether it will be a quick, it will be a continued rally, or it will just be how to say what is that, a bull trap lah, where you can you will go down further, it will go down further. We would not know. And of course, if you are more gung-ho, and if you want to catch the as much as possible the rally up, and as fast as and as much as possible, then of course you can always go on a straight call, which, but of course those are actually more expensive, yeah, and you have to go on the direction quick, yeah. So that's all from us, and hope you like this session today, and I wish you all the best and on trading the stock market. Again, be nimble, still keep your position small and limited, just in case that the market goes the other way. Then of course you can still protect your portfolio, or protect your capital. Okay, so until next time, we will catch you again. Please share and like the video and our Facebook page. Please post whatever questions you have, and we'll be glad to answer any of them. And have a safe trading week, and I wish you all the best. Bye bye.